everybody. I hope you're doing well. Thanks a lot for joining me in this weekend market update. I've just sat down and actually recorded that of Saturday's Pivot Point Pro analysis class. That is up on the website. It went a little bit longer this week. It was about approximately an hour and 45 minutes. A really good discussion around what is currently happening, what has happened anyway over the abbreviated week's worth of trade, the past 4 sessions. I'd be very careful, and this is another warning to the boisterous bulls out there. Be careful what you wish for. It really looks as though potentially the chickens are coming home to roost. What you have seen across the board, collectively speaking, on the US financial markets over the past 4 sessions, in my opinion, has been a flat-out reversal. We recapped it in really good detail, I believe, in that pro analysis class, really carefully and considerately. Let me just point out a couple of things to you in this public forum. First of all, this is the chart of the S&P 500. Take a look at this, distinguishment between that of Tuesday's candlestick just here and that of Wednesday's candlestick. To the untrained eye, it may not look like anything whatsoever. However, there is a very, very considered and careful distinction between these 2 trading sessions that took place on Tuesday and Wednesday of the week just gone. In fact, on Thursday, as at the close, I was sitting down tentatively to bring you that of a recording. However, I thought it would be best just to leave it alone until the end of close on Friday. This is now extended through to Saturday afternoon local time here after the pro analysis discussion. However, I just couldn't help myself. I needed to put this out on the airwaves. Again, now that I've gone off on a tangent, let me just relate this back into the difference between Tuesday and Wednesday. Pay attention to this gap just here. It says it all. The context of where it is, the location that it's occurring with, coupled with those divergent signals and also those 3-day reversal patterns that were setting up really about 1.5 weeks ago that never truly committed. That is what established out of the trapdoor. But before we get into the trapdoor, I just wanted to show you a couple of things in terms of psychology and mass sentiment reversal that is happening as at Wednesday through Friday. Again, we come into the week on Tuesday after President's Day on Monday. Bit of an ordinary candlestick here on the S&P 500. What you see is, again, knee-jerk reaction, a gap to the upside on Wednesday. It creates the open window. We tried to see a push and a continuation, a close and a continuation above that and during that of Wednesday's session. However, we couldn't actually achieve it on the S&P 500. We pushed up intra-session. We saw the very clear rejection of this level during Wednesday's session. When I say rejection, I say about the failed holding and continuation above that of the previous session's candlesticks over here. Again, just to take you back, this was back at the historical all-time highs whereby it failed at. Then we, of course, fast forward or rewind, subjectively, depending on what time frame you're looking at this market on Thursday. We see the gap closure of this. During Thursday's session, it was looking very, very ominous. It was a long day dark Morobozu outside day engulfing candlestick. However, again, we bounced off from, or at least off from the intra-session lows on Thursday, really just closing out the difference between that of Tuesday's intra-session high and that of the intra-session low on Wednesday's candle. You can see here on Thursday, we closed right at the low of that gap. Okay. Then, of course, fast forward or rewind to yesterday's candlestick being Friday. We just saw the all-out collapse and potentially that of the closure. It was the closure below that of Thursday's intra-session low. And we're getting very, very close to the aforementioned video prior to this video here in the public forum talking about stock market trapdoors. Now, this is in context and applicable to that of the S&P 500. When I bring this up for the NASDAQ, have a look at this. It's even more distinguished. Again, similarities are running all over the place. I'm just picking up on some of these exhaustion moves in the context of broader divergent signals and just a complete lack of momentum and a continuation to the upside. There are sort of just landmines all over the place in the landscape, the lay of the land of the US financial market indices that we've been speaking about publicly for. And I think that you're really on the left-hand shoulder of this steamroller heading towards the markets that I'm very much concerned about. And that's why I'm sitting down on this Saturday, bringing it to your attention or at least on my weekend anyway. So this is the chart of the NASDAQ. Again, you want to pay attention to Tuesday and also Wednesday's candlestick signals here. Again, we floated the idea that maybe we're just setting up a stair-step combination, or at least a stair-step pattern, very similar to what we were talking about on the S&P 500. The Dow Jones Industrial Average, we floated the idea of a bull flag continuation. Again, before I go off on a tangent, let me just recap this back into the NASDAQ. You see the gap up on Wednesday. What happened? Again, we failed to hold this level. It was a break above what was at that particular juncture. A closing price once again at fresh new all-time highs. However, on Thursday, we saw the very clear rejection of this current level that we printed on Wednesday. We closed the open window, entered into a little bit of a flash crash, so to speak, on Thursday. We recovered off from the intra-session lows. However, Again, yesterday, or as at the close on Friday, we're really seeing potentially that net momentum shift to the downside. This is after the flat out exhaustion gaps. In fact, if you go back to the video catalog here on the YouTube channel, you can see there's quite a mix of videos calling for exhaustion gaps and also bearish divergences all over the place. If I just bring up the MACD, these are what we call oscillating indicators. And if I just show you this in context, I just pushed the wrong key on my keyboard, pardon me. But if I show you this in context of the MACD over here, the moving average convergence divergence, you can see that price again, although it has once again more recently, even as most recent, as about 1.5 weeks ago on the Dow Jones Industrial Average, created that fresh new all-time high. After the sell side volume and the net directional, right, bearish movement that's happened on Thursday and Friday, we've now definitively crossed on the MACD. You can see the fast line, what we call the signal line, cross over the slow line. This just sets off a chain of generally adverse reactions when it comes to price action in the US financial market indices. You can see the RSI turning down, the stochastics, the fast line is just pushed out of negative territory. All of these signals here, this is on a daily time frame, mixed with the bearish divergence, mixed with, of course, this 3-day reversal candlestick here being that evening star reversal pattern that at that particular juncture led to nothing, which essentially just set up the trapdoor to begin with, right? Which is why we've got the trigger here at 28,923 on the Dow. When I show you on the S&P 500, 3310, and on the NASDAQ, it's a little bit lower down here at 9463. But again, I hope you can see the culmination of what this means for the markets. When you bring all of these, I guess not all of them that I'm going over by far, any stretch of the imagination in this public forum, but when you start layering it, especially when you start going out into larger fractals outside of the daily time frame, when I start bringing this into the weekly time frame, a lot of the gains that were made at least 1 week ago, not of course considering where the markets closed yesterday, but the week prior, you can see on the S&P 500, pretty much gave back the majority of those gains, down 42 points at this particular point. The Dow Jones Industrial Average closing at the lows of the previous week's real body candle, down 405 points. NASDAQ's a little bit of a different story. This really looks like that of a shooting star type of candlestick pattern. But it gets even more interesting because when you go out to the Russell, have a look at this. You can see you've got an inside day spinning top right at the mix of this candlestick swing high over here, going back to very early period in 2020. And when I go out to the daily time frame on this particular chart, you've got bearish divergence, which runs all the way back to the late stage of December. Pretty much, even prior to that, it almost goes back to November as well. So this has been a multi-month divergence setting up. This looks like a clear flat-out rejection. If anyone was privy to that previous analysis class that we were in Pro, we were talking about that third decelerated fan line, going back to the macro primary trend, which established in March of 2009. All of this is aligning, although it's taken a little bit longer than what originally I thought it would. All of this is falling together very nicely. And what that means is when it comes to the structure of the markets, it's as if someone's just knocked out the first brick in the actual brick framework and really the sort of the integrity of the structure itself, of whatever structure we're talking about. It seems as though it's got that first major problem to the structure. At least it's got that first erosion to it whereby the integrity itself is somewhat compromised. I mean, that's essentially what's happened Thursday through Friday in the US financial market indices. And it's a very good chance at this particular point that we are on the left shoulder of something much, much greater. And again, I can sit here and talk until I'm blue in the face, and maybe some people will realize, I mean, obviously the majority won't. They'll be a little bit complacent and completely oblivious to it. That's just the way it's going to be. You can't really sort of argue against that or for that. It's just the way it is. Got to leave it be. But at this particular point, considering what we have seen, all right, it seems to me that momentum is really, at this particular juncture, beginning to switch, beginning to change. And we might be right on the edge of that. Something that was more so maybe a little bit ethereal, or maybe it might have seemed a little bit more flippant. Maybe it's becoming a little bit more real for those who are actively looking at these markets. And if you wanted to look at it sort of a more of a along the ways type of market, if you had the beginning of a correction to a market which is more advanced in terms of a correction setting up, you'd have the NASDAQ on the left-hand side where it's just beginning, and you have the Dow Jones Industrial Average closer to the legitimate reaction, or at least the correction. Because when you look at this, it really looks like the M word that I'm not allowed to say, probably on YouTube, but you can certainly see the double top just here, right, under formation. If this starts to crack below again where the trapdoor is, and we start coming back down to the neckline, and if you wanted to do a measured move projection just from the M itself down to the neckline and then project it, this might become, or at least sound, a little bit almost impossible to a lot of people, but an absolute minimum, you're looking at the industrial average coming down to say 27,000 on the nose, which essentially is the confluence and a retest of what was historical resistance, taking us back to 2019. The reality is when you overstretch this with the Dow Jones Transportational Average, and if you wanted to look at the Transportational Average as a comparative sort of, you can overlay it against the industrial average just to give you a complete breakdown in the non-committal state and the application of Dow theory at the moment. You can see that what I've done is I've just overlaid the industrial average in purple, and then if I bring up the transportational average in black, you can see the transportational average more so turning down. But what's more compelling is that the transportational average, if you still look at this in the colored black, I know they're very similar colors. My apologies for that. It's just the default colors that at this point I shouldn't change. But you can see here that in terms of the transportational average, all right, it never got above its swing high over here in September of 2018 relative to where we are over here at 10,908 points, whereby the industrial average, which was relatively priced over here in September and October of 2018, it's certainly above it. So there's a complete disconnect, a complete breakdown going on between this in terms of Dow theory confirmation. On top of that, when you want to look at the divergences on the transportational average, you've got multi-month divergences here. And once this bottom level gives out, it's just going to be an absolute bloodbath that you can see from a mile away. Market breadth is critical. This is all just flashing amber at the moment. It's pretty much borderline red, just to say jump, because as soon as this gets going, all right, whether or not the media try and relate this through to the coronavirus or whatever it is, the supply chain massacre happening when it comes to information technology goods that are generally manufactured out of China and then shipped globally. Whatever supply chain they want to link this to, or whatever sort of degrading of global GDP in which quarter it shows up in, depending on the LEIs. By the way, take a look at the spread on the 10 and the 2 year. Look at that complete almost secondary inversal or inversion that you're about to sort of recommit to, which is essentially going to push us inverted for another 1 to 2 years. And then pretty much this whole game is up. But I just wanted to say, if you want to understand the timestamp of where we are in these markets and what this means for a bunch of these information technology stocks, all these stocks on the left-hand side of my screen, have a look into that analysis class. If you really wanted to see the narrative and at least the parallels between individual stocks and what's happening in the actual indices, and a very rare occurrence, and generally when it does occur, when you do pick up on it, even on the daily, if you want to go out into a larger fractal onto a weekly chart, take a look at the relationship between that of the NASDAQ and Apple. Have a look at what's happening at the moment, whereby you've completely stalled out in the price of Apple over the past 2 months. And you're just seeing all of these oscillators just tell you, or at least there's a finite amount of people who are actually picking up on this before it's too late. As soon as Apple cracks below 300, this is going to get ugly. And it's going to get ugly really hit. Apple's going to get hit. It's going to get hit, and it's going to get hit hard. And it's only a matter of time until this happens. You've got the 50-day potentially holding this up. Maybe you might see a secondary bounce to retest and set up another consecutive lower high. But all of this is just coming together, unfortunately, for the mass people out there who simply don't know what this actually means, what it justifies, what it stands for. And that's a real shame. At this point, again, we're still looking at a continuation of the broader macro continuation into 2020. I think that's still relatively safe at this particular time. But certainly on that intermediate time frame, whether or not you wanted to look at Apple, whether or not you wanted to look at the very short-term double top again on Amazon, if you wanted to extend that into Microsoft, right? You've got a leaning double top here. Oh, maybe we should look at Google. What's Google doing? It's got a Japanese rounding top, right? A dumpling top just over here. Take your pick. You've got COP, which is just down. You've got Caterpillar getting hammered as well. A whole bunch of these shares are under really undue or duress at this particular point. And you can just see in the individual technical charts just here what this can really turn into in a relatively sort of short period of time. If you wanted to learn more, again, have a look into that analysis class. But as it stands, it really looks as that dynamic is now significantly sort of, or at least the light switch, it has been flicked. And it's, I think after the week just gone over the past 4 sessions, I think we've gone through a dramatic or a significant sort of pivot in terms of momentum that's only going to foster further directional movement in the opposite direction to, I guess, the prevailing sentiment and I guess what the majority of people are expecting this market to do. Stay tuned, everyone. I'll recap it for you. I know I've been a little bit quiet over the past week or so. Again, I was sort of very close to recording us at the close on Thursday, but I thought, hey, I'll just leave it another session until Friday. Hopefully we'd have something more substantial in terms of the narrative that I've been speaking about. And I really think that price action itself is really speaking and backing up and confirming a lot of what I've been talking about really since, and really the entirety so far through 2020. A lot of these markets are under pressure. We'll see whether or not they're pushed into further pressure. And if you want to learn more about that pressure, have a look into that analysis class. It's up on the website at the moment. The link is in the description. All right, everyone, enjoy your weekend. It's James signing off on behalf of Pivot Point Trading. Farewell.